Good afternoon. Welcome to our webcast, The First Financial Forum. We host our webcast covering important topics pertaining to banking, the economy, and the financial sector. I'm Bliss Morris, the founder and CEO of First Financial Network. I began my career a number of years ago with the FDIC and ultimately founded First Financial in 1989. We're getting ready to celebrate our 35th anniversary, which is super exciting. We work with money center, regional, and community banks, as well as the FDIC and other financial institutions. Last year, we sold $1.8 billion in commercial real estate and residential loans. I'm super excited this afternoon to introduce our esteemed guest, Jeff DiModica. Jeff has been the president and managing director of Starwood Property Trust since 2014 and served as an external director of the company from its inception in 2009 to 2014. In his current role, he leads and serves as a member of the investment committee of each of the company's business lines, including large loan lending, residential lending, infrastructure lending, property investing, and investing and servicing, which have a collective $28 billion of assets under management. Prior to joining Starwood, Jeff served in several roles at the Royal Bank of Scotland and Merrill Lynch. And I loved this, Jeff, when I read this in your bio, that you began your career at Chemical Bank. Boy, that takes me back a few decades for sure, right? So, yeah.
It was the 80s, but I'm a little embarrassed to say
Yeah,
that.
no, it's a good thing. It's a good thing. And I was thinking about it, and I hope I remember this correctly, that I think Chemical Bank actually bought Chase, but they kept the Chase name and look at where JP Morgan Chase is today. So that's kind of phenomenal. But Starwood's core business focuses on originating, acquiring, financing, and managing commercial mortgage loans and other commercial real estate debt instruments. I mean, literally, Starwood covers every bit of the cycle, really, of a loan, which is phenomenal. The business has grown dramatically, and Starwood Property Trust today is the largest commercial mortgage REIT in the U.S., with a market cap of approximately $6 billion. This will take you back too. So I was thinking, when did I become aware of Starwood? And I'm pretty sure it was at some point during the savings and loan crisis in the 90s. And I believe that Barry Sternlicht, at that point, the Starwood's founder, was buying apartments from the Resolution Trust Corporation. And that's where he got his start, where so many of the big real estate investment companies got their starts as well. It's really something. FFN was performing outcry auctions of large loan portfolios for the RTC back then. So I'm sure that's the connection. And then I remember I was thinking back to the GFC, and when Starwood and TPG acquired the assets from the failed Chorus Bank, and partnered with the FDIC to really resolve some huge numbers there. So I think where I want to start today, Jeff, is, obviously we have a big current announcement today from the Fed, and they have decreased the key interest rate by 0.5 point. So that's super exciting. And, after experiencing 11 interest rate hikes since 2022, which is just some phenomenal increases. I'm interested to learn, and I know the audience that's dialed in will be too, that, how does the move from higher and then to lower rates affect your portfolio and portfolios like Starwood's?
Yeah, well, first, thank you for having me. It's really a pleasure to be at a place like Starwood. But like you said, we do see so many things. Our market cap for a minute ago just hit $7 billion again, which was good. We're couple of cents off of that, but this rally is good. I was going to be late for this because I was cleaning up the confetti and I spilled some champagne on my desk when the Fed finally did their thing.
That's great.
I've been waiting for a minute, and Barry's been fairly outspoken. Barry Sternlicht, the CEO, founder of Starwood. He started Starwood Hotels, created Starwood Capital Group in the early 90s or so, and we started this public company in 2009 as a blind pool IPO. I think it was $900 million blind pool IPO, the largest of that. Post the GFC, it was the largest blind pool. And we've grown it, like we said, up to $7 billion. Most importantly, we've diversified the heck out of that business. And that is basically where most of our lending vehicles sit, although we have a large owned property business in there as well. And the rest of Starwood Capital is opportunity funds and other that make up $75 billion or so of equity assets. So we're in every market. We probably do more in Europe as a percentage of our book than just about anybody else. We've had boots on the ground there for a long time. We're very much a global firm. And I joined here after being on the external board of directors for 5 years. I came in as president in 14. You said I started at Chemical. Chemical was quite a place. I was really fortunate to go through what was the greatest training program in the history of commercial real estate on Wall Street. And so many people are now in the C-suite. I won't go through them all, but in my little group in merchant investment banking of probably 12 people, I think 7 of us ended up running fairly large real estate companies. So it was a great start. Real estate is really about relationships and your ability to get deals done.
Totally.
About your reputation and your relationships, and I was really fortunate to start at a place like that. So thank you, and thanks for having me. So rates, rates is interesting, and it's a bit perverse in a way. We're generically a floating rate lender. Our peers who are commercial mortgage REITs, they do one thing: they write loans 60, 65, 70% LTV on large commercial real estate projects. We probably all have a little bit more multifamily than anything else, but some of my peers have 30 to 40% US office. We only have 10% US office.
Right.
And the entirety of their businesses is making loans where we will write a $70 million loan on a $100 million commercial real estate asset. And we'll borrow $50 million. And we have a number of ways that we'll borrow that. And I'll get to your question.
No, you're good.
Give me a little background. We'll borrow $50 million of that $70 million loan, one of 3 ways: either on a bank repo line, we will do a CLO financing, or we'll sell an E-note. I guess there's a fourth: we can issue unsecured, and we have issued more unsecured debt than just about anybody else. We also have term loans, so we can finance them in a bunch of ways. The cheapest, in the way that most of my peers run their business predominantly, is commercial real estate loans funded by bank repo lines. And when I borrow 50 cents on that dollar equity asset and $70 million loan on a bank warehouse line, I give up 3 important things in order to get a decent advance rate and the lowest cost of funds. And that is, I give them the ability to credit mark me if there's a credit deterioration. In COVID, hotels shut overnight. That was a credit mark. A large tenant in an office building leaves, you're likely getting a credit mark. The assets deteriorated at the time of a roll, you're likely getting a credit mark. They then have the ability, and I think it's the most important thing that they pick up, they have the ability to utilize their cross on the asset. So if I have 11 different lines or so that I really use, and 4 of them are over $2 billion, if I don't make that margin call, other people call it voluntary deleveraging. I call it a margin call if they ask me for money. If I don't make that margin call, they have the ability to sell out my entire line. And that line across on those assets, there's probably a number of assets that have a lot of equity in them, and we certainly don't want that. So that's the most valuable thing for the bank, I think. And the third thing they get is recourse. And recourse to Starwood Property Trust, strong BB credit. We think we're on our way to investment grade. Is worth maybe more than it is to other people. And I think we end up borrowing a little bit inside. But in general, because we all use these different ways of financing ourselves, our peers and we own what I consider to be sort of a 50 to 70% LTV slice of a loan. And with that leverage, we're able to earn 11, 12, 13% on that. And we pay out today a 9.5, 9.25% dividend yield. Our peers pay out probably closer to 12 or 13, but that is the entirety of my peer group's business. You mentioned, and I will go into in more detail, that we've massively diversified this company. So we have 6 other lending businesses. We have 7 different verticals, and the CRE lending business is only a little over half of our business, which has been really good for us in this last 3 years where rates have gone up and the amount of cushion that we have in these loan books have gone down. I go into all that because we make what we call transitional floating rate loans. They're generic 3-year floating rate loans with 2 1-year extensions. It's always different, they're bespoke, but for the most part, that is what it is. And by making floating rate loans, we actually make more money when SOFR is higher, formerly LIBOR, when floating rates are higher, when Fed funds is higher. So this move lower today that we're celebrating, and I'm still waving up confetti from, will lower the earnings of public mortgage REITs and of all floating rate lenders, which is the bulk of these books. Actually, I'm going to go back a little bit further because this I think is really interesting. when I think back in my career, when I started my career, the world was a fixed rate lending world for the most part. There were floating rate loans, but Bliss, you remember it was much more fixed floating rate. And what happened at the great financial crisis, commercial real estate values went down 35 to 40%. And a lot of the large sovereigns, insurance companies, family offices, et cetera, who were investing in commercial real estate, their boss tapped them on their shoulder and said, "You're not very good at this. This guy from Blackstone keeps calling me. They say they're experts. We're going to give them our money, and we're not going to have you manage the money anymore." And they moved around what people did, and there was this massive growth of this private equity real estate world that is now the dominant player in commercial real estate. Well, what happened when you took the keys away from pensions, insurers, sovereigns, and wealthy families, and you gave them to private equity? Private equity borrows floating because they don't want 10-year loans, because they have a 6 or 7 year fund. They don't want to have to deal with call protection and having to pay off a fixed rate loan. So the world that you and I grew up in, that was 75% fixed rate, 25% floating, has become a 75% floating, 25% fixed rate world since the growth of these private equity companies. So lenders, we all make more in that case, but what's happened now over 3 years is, in our old life, 10-year fixed rate loans, you had 3 years of high LIBOR SOFR. If you lost the loan lottery and you were maturing, your loan is maturing in the 3 years that you happen to have out of the 10 years of your fixed rate, your loan's maturing in those 3 years, you have to pay the piper and you would have to come up with capital, and it's a difficult environment, much like it is for a floating rate lender. But 70% of loans wouldn't have had to refinance themselves in this. They just cruise on, kind of like the CMBS market does today.
Right.
But because the world has moved to floating, everybody, we're now here for 3 years. We've been stuck here, and we're going to be here for 6 to 9 months more. And everybody has to sort of pay the piper. So floating rate loans have become very difficult from a credit perspective, because every one of them has had a day in court with their lender to try to figure out, how do I extend? Do I extend? And am I able to extend? So even though we make more money when SOFR is higher, the credit on our books deteriorates when it's higher, because the refinanceability of these loans kind of go away. So if I think about those 11 hikes that you started this question with, and we were making loans at 65 or 70 LTV. Well, what happened when cap rates immediately went higher as rates went higher? So if I was lending at 70 LTV, and if a 4 cap became a 6 cap, well, I'm now underwater on that loan. I've lost all 30 points of cushion that I had, because I'm above 100 LTV at a 6 cap. At a 5 1/4, 5.5 cap, my cushion's gone, but I haven't moved to negative yet. And realistically, cap rates widened by 30% very quickly. And by widening 30%, our cushion, being a 70% lender, was gone. And because our cushion was gone, it made the forward curve more important than it's ever been in my career. And why do I say that? Well, if you're lending at 70 LTV, it doesn't really matter. You want the asset to perform well. You want someone to execute their business plan. But if you're lending at 100 LTV, you really need rates to be lower tomorrow than they are today to get out of your loan. And
so to save commercial real estate, how low do they have to get? I mean, right?
I think they don't have to get all the way back, and I'll go into that.
Not down to
I'll go into that
zero.
And it's somewhere between where we were and where we are, and I'll get into a little more when we talk about the property types. But all of a sudden, for the last 2 years, I've lost a lot of sleep. Everybody from banks who do this to guys like me who do this, we've lost sleep because this cushion went away as cap rates went up. And so we've been very focused on the forward SOFR curve. And it's been interesting. Today, the forward SOFR curve is saying that SOFR will be at 3.4% in March of next year. And then it's going down to 3% in 2026 and 2027.
Wow.
If I look at the forward curve, over the last year and a half, it's been remarkable, and I've had big bags under my eyes, and I've been relatively happy. If I look at it over the last 18 months or so, going back to May of 2023, the forward curve looked very similar to today's forward curve. In April of this year, the forward curve looked very similar to today's existing forward curve. In all three of those scenarios, today, in May of 23, and in April of 24, I felt very good about the refinanceability of our $28 billion balance sheet. And banks who have large loans, et cetera, because if we get down there and then my LTVs come back well inside of 100, and not that they all got to 100, but they start creeping closer to 70. And the reality is cash flow has gone up on most of our assets. Cash flow has gone up on our multis. It's gone up on our hotels. It's gone up on our industrial. So I don't need to go all the way back to 25 basis point LIBOR because they're making more money. I just need
Right.
some relief from where we were, where we felt like it was cuspy. But in the middle of those three data points, May of 23, April of this year, and today, where we have this SOFR curve, we had the build up to and the crescendo of significantly higher forward curves. So in October of 23, the forward curve was saying that SOFR in that same period, late 25, early 26, would be 4.5. In April and May of this year, seems like forever ago. It was 4 months ago.
Right.
SOFR curve was saying the same thing, that in that period in 26 would be mid fours. At a mid four SOFR, we as an industry are under reserved, and we're going to have larger losses than we thought. And at a high twos, low threes, mid threes, high threes SOFR, we're probably over reserved across all real estate lenders. I'm not talking about Starwood Property Trust here, and we feel really good. So this swing, because cap rates widened enough that our cushion went away, this forward SOFR is really important. Now, what I think the public markets miss is my stock has been plus minus $20 in all 5 of those scenarios. For those of you writing it down and watching at home, I probably would sell companies like mine when forward SOFR curves in the mid fours, and I'd love to buy them when forward SOFR's in the low mid threes. And the market certainly hasn't traded us that way, but we lose sleep every night based on that. So given the cushion's gone, I'm very happy that the Fed went 50. I do believe for the first time in a long time, I've been saying the forward curve's never right. It's a mathematical construct, but I believe it's more right than wrong. And Barry last night, and Barry thinks it's very much more right than wrong, and that they're going to keep going. There's a lot of reasons to think they may or may not, but long-winded answer.
Well, I know he's been very vocal about what he thought the Fed should do. And, I totally understand that. Okay. So I want to move into talking about banking, in some of what the banks are facing today. And, something I've read a lot about is the fact that we've probably got about a third of our U.S. operating banks that are in the U.S. holding commercial real estate loan exposures of more than 300% of their tier 1 capital, which and there's even a lot of institutions up at the 400% and some at the 500%. Pretty startling, actually. So what are you hearing? And I think every time we enter a cycle, Wall Street and others try to come up with new structures and things that might help weather the storm, right? You've seen them, I've seen them. You guys have even participated in some of them.
Yeah.
So what are you hearing from the investment banks, the commercial banks, regarding the interest in using like a, significant risk transfer, credit risk transfer structure to reduce credit risk and provide, the regulatory capital relief they're going to need? And who knows where we end up, with Basel III and all of that. Mm-hmm. So talk to me about that and what you're hearing and really how regulatory capital relates to a bank's loan book.
Yeah, sure. I'm more sanguine on this than a lot of people. I look at large banks and some that are in those percentages that you have of CRE. And in the end of the day, I remember that banks are lending at 60% LTV on whole loans. They're lending to me and loan on loan or repo at plus minus 50% LTV. I started this by telling you I'm a 65 to 75 LTV lender. So they're less levered to losses than my industry is. So by nature, if there's ever a guy who's talking their book, I'm going to talk my book and tell you that they're fine, because if they're not fine, guys like me are probably not very fine. But those percentages, I think, are misnomers a little bit. So what's happened in the last 10 years? In the last 10 years, we've had extremely low rates. We've had very tight historic credit spreads. So every company has had the ability to term out their debt in the high yield markets and the investment grade bond markets. And they have taken advantage of that. We have active investment bankers who get paid a lot of fees to get them to term out and then to extend their loans in the capital markets. And the capital markets have become a much bigger part of financing companies. And so the banks, if I look back a bunch of years, because I'm comparing this to where the banks were historically, the banks had much more C&I loans back in the day. And today, a lot of that has been absorbed at really tight spreads and low rates and put away for 10 years or more in the capital markets. So by definition, CRE becomes a bigger percentage when that denominator shifts. you look at the last 3 years. In the last 3 years, how many people on this call have taken out of absent, young people who are buying their first home? Most of us haven't moved because we have an in the money mortgage. There's very few home mortgages getting done, and home mortgages are a big part of a bank's balance sheet. They're not writing any anymore. Right. So C&I is down significantly, and resi loans are down significantly. Well, without even changing the amount of CRE that you have a higher percentage because the denominator has shifted. And I don't lose a lot of sleep about that. I think more about look through LTVs and things like that. But then I try to put myself, whenever I'm dealing with the banks, I try to put myself in their shoes. And whenever I'm dealing with anybody, it's a much better perspective to get to a yes on anything if you can put yourself in someone else's shoes. And I say, well, why do they do what they do? And you talked about regulatory capital and SRT and CRT type trades. We are seeing those again for the first time in a while. The banks do want to lower their regulatory capital burden. One way to do that is to sell a small percentage of the first loss piece in CRT, SRT. We're not going to play in those. I should be careful. I just had calls with 2 banks looking at deals. They think I might play in them, but ultimately the people who are going to play in them can't originate their own product. They can't create real estate NIM and margin spread the way that we can. And so it's a nice way in a first loss piece for somebody to get an 11% yield plus minus for taking the bottom of either a crossed pool of assets or a single asset. But it's not going to be guys like us because we can create more spread than that in the whole loan market. But we will see them use that to lower their regulatory capital burden. I think it's really important for people, and I think most people, and I think people even at the banks that I talk to don't really understand what's happening with Basel III. And we had a pullback last Friday. There was a headline that the SIFI banks are going to have to hold only 50% as much excess capacity capital as we thought that they were going to under the new Basel III. So they're pulling back on Basel III. Tells me that the banks have spent money well with good lobbyists and convinced somebody in DC that's worth their time, or at least that they have a better chance of getting reelected with lower capital charges for the banks. So good for them. We're not part of that. But yeah, I think you kind of have to understand what the capital charges are. And so I like to think about it as a CRE loan. CRE loans have a capital ratio, and capital ratio is 10%. Every asset has a capital ratio in a bank. Right. So if a bank makes $100 million CRE loan, and CRE is a 10% capital ratio asset, and a whole loan, them making the loan directly, is 100% regulatory capital. So they have to reserve 100% of 10%, or put $10 aside to make a $100 million loan. Right. $1 million aside to make a $100 million loan. Embedded in that is 10 turns of leverage for the bank. And that's a good business. It returns low to mid 20s ROA. The repo business is considered, because it's a loan on loan. I started this by saying they pick up a margin call ability, pick up a cross, which is the most valuable. But the reason they get 20% regulatory capital charges on that is because it's also a corporate loan, because there's a recourse element to it. And because of that recourse element, 20% regulatory capital means that they have to hold 20% of the capital ratio, or 20% of the 10%. So on a $100 million loan in repo, they only have to hold $2 of equity, $2 million of equity, as opposed to $10 million of equity in a whole loan. So they can be 50 times levered in a loan on loan structure, in a repo structure. They don't make quite the same amount of spread. Their costs are a little higher. Right. But the best of my calculations, it's a mid to high 50s ROE business for them at zero loss. I'm assuming zero loss and everything. So it's more than double the ROE of making whole loans. Yeah. It doesn't take long for a bank CEO to say, I want more of that and less of that, and everybody else is doing more of that, so I'm going to do more of that. So I expect, and I've seen, all of my banks are willing to offer us more capacity. I think overall I have like 34 different bank lines and $19 billion or so of capacity, of which I'm using a fraction of it today. And they want to do more because it's a better ROE business for them. And these capital charges are sort of forcing that, and they're forcing CRT. So I think the banks have, if the CRT market sort of takes off, they might be competitors again, but it's a really good time for us as a lender, because the banks tend to be competition. We write loans, very important here, very different than probably a lot of people on here. Our average loan size is well over $100 million. So we're writing bigger loans that the banks will also be interested in writing. So the banks are our biggest competition. The insurance companies, to some extent, are our competition. Some large debt funds today are our competition. The other mortgage REITs haven't really invested in the last 3 years. We've invested every quarter in every part of our business over the last 3 years, even in this rate rise, our board has had strong conviction that we have the liquidity to do so. We have the ability to raise capital. We just raised $400 million of equity last week with the first mortgage REIT post-crisis to do it. We've done it twice. We've issued debt in the last year, but we stood alone because, as I started this, only half our book is these assets, and we're only 10% U.S. office, and we're only 2.3 turns levered. Our peer group is more in the 3 to 4.7 turns levered. So we're less levered, less office, and only half of our assets are there. But in general, our REIT competitors aren't investing, in the banks for these regulatory capital reasons aren't investing. So we have a much clearer windshield of investment opportunities as post this move. We are going to see a significant increase in the amount of transactions. Transaction volume will increase massively. It's been waiting to see the whites of the eyes of this. And there's certainly a lot of people who have lost all their equity in a trade that aren't motivated to go in and crystallize that loss. So that won't trade. But it's a lot of funds, and there's a lot of assets, as I started talking about this, in multis and industrial, and certainly in data centers and other places where you've had cash flow push, where you have executed your business plan, but you're not down and out, and you may actually be up. And so I think we'll start to see transaction volume come back, and we'll see volume come back on the refi side. And for us, we did this equity because we want to grow. We have non-accrual assets like all of our peers, assets that aren't earning anything today because we're trying to write down the loan balance effectively over time. And we're gonna out earn that by investing. And so we have said publicly that we are going tremendously on offense, and having the banks be a little less on offense and having the other REITs be a little less on offense is really good for us.
Okay, I've got a question for you in regards to the REIT, and you're sitting at less than 10% office. I would think that was by design. Why? I'm curious. Because it's very different than many.
It's very different than many. We do have a couple of percent in Europe, 1.5%, I think, which would bring us up to 11. Our European book is fine. People actually go back to work in Europe.
They went back to work. Yes, they did.
People have actually gone back to work in Asia. Yeah. It's crazy. We can't. Nobody in the government has gone back 4 years after COVID. It's astonishing. I always thought DC was an easy place to lend because there's always going to be new GSA tenants, and government's always going to get bigger. And all of a sudden, COVID was not in my model. So I would say we've done a few things that have informed that view of it. We've never lent at all in Chicago, just in our whole history. Barry used to work there. We just think it never goes up, and it is what it is. San Francisco was an easy place to get long office, and we sort of avoided it because those of us who are old were here in 2000, and tech goes up and down more quickly than other things, and we don't really want to lose sleep over that. And so we've under-indexed that significantly. And I would say we under-indexed New York for the same reason. Financial services volatility is extreme. Don't have to look further than 07, et cetera. So if you're not going to be in those big markets, you're probably not doing nearly as much on the office side. We got tempted a few times to do things like life science that people have now pulled out of their office exposure. Ultimately, 4 years after the guys coming to us with life science deals, we did one deal, less than $100 million. It's basis points on our overall. And I'm kicking myself because for 4 years, I said to everybody on my team, why do we need 3 or 4 times as much life science in 2025 as we had in 2020, in 2019? It just doesn't make sense to me. And I said, once you can show me that we're graduating 4 to 5 times as many scientists, then I'll tell you we need 4 to 5 times as much life sciences. But until then, every B office can't convert at a 2x the basis to life science, because when you get hung and you now have to bring it back, because it's very expensive to build them, you have to bring it back to regular office, and your net effective rents are a fraction of what you thought. People are going to lose a lot of money. And we didn't get tempted into that. And that was sort of the theory that I had. I'm sure other people had other reasons, but a lot of our peers sort of leaned in there, and it just never really made sense to me. So I think the office is a little bit about markets for us. We have no loan exposure at all in San Francisco. I think we'll be wrong there now. I do think that with AI and where things have gone to pricing wise, I do think West Coast office is actually looking fairly cheap. But by under-indexing Manhattan, we have no office building exposure in Manhattan. Wow. San Francisco, it would be really hard to have 37% and have it all in other markets. Now, listen, other markets aren't all perfect. We have a couple of loans in DC. You can go to our public financials. One we're going to convert to residential.
One you're converting
happens to be one that's convertible, and not everything is. Very few are, and you have to have the right elevator banks, the right window lines. You have to be in the right neighborhood. There's just a lot of reasons why that generically doesn't work. One will probably be a much more difficult asset because looking for GSA tenants in the lease side. We have an asset in Houston, an asset in Dallas that that those haven't been great markets. So, you know, within our 10%, it's not like everything is rosy, but we've taken over $500 million of reserves. So our best estimate of where those losses would potentially come in is already built into our GAAP financials. As I said here, this massive move lower in rates probably makes me feel better about those reserves being more than enough when I think about them. But
Sure.
I think it started by being a market thing, and you know, office is difficult. The other thing about office that we've always talked about here is the concept of getting a new tenant into an office is what we call good news money. We're happy to fund tenant improvements and leasing commissions because we're getting more cash flow into the building. Well, when things turn sideways like this, I don't necessarily want to fund a new lease because I'm just accreting my basis. My basis is going higher, and I may be underwater in one of those markets if it's one of my more difficult assets. And so we've done since 2020, and you know, most of our loan book is post 2020 at this point. Since 2020, we've cut our future funding and our construction exposure more than in half. So how do we consciously do that? One easy way to do that is to do less office. You know, you reduce the amount of future funding that you need, then you never get dragged into the capital markets when you don't want to be in the capital markets, which I think is really important if you're trying to build a generational business like we're trying to build here at Starwood. This is not a trade. We've also learned from sort of mistakes of mortgage REITs past. I won't pick on any, but in 2000 and 2007, a bunch went out of business and they weren't diversified. They had
Right.
too much future
Right.
funding. They had too many land loans, too much without cash flow, and you just don't come through if that's the case. We also learned that it's really nice to have unsecured debt because if the market completely blows up, we can buy that back at a discount, and that's helped some people survive those times. So I think we're good students of history in mortgage REIT world, even though it's, you know, not our whole lives, but it's most of our lives in commercial real estate, and that's probably led us to this position. We're also very fortunate that we have built this very large non-US business. 34%, I think, of our loans today are outside of the US, and that tends to be less on the office side as well. It's much less on the office side for us. So by diversifying geographically, it's certainly helped. But yeah, it's a theme that we kind of stuck with, and you know, worked out, and diversifying worked out.
Yeah, yeah, no, for sure. And to your point, I mean, like you said, I mean, people are back at work in other geographic areas around the world. I don't know what it's going to take here, but I'm glad our team is back in the office and has been for a long time.
Yeah.
So you were talking about office, and I want to switch a little bit now and keep focusing on commercial real estate and in the landscape. You know, obviously in the CMBS world, you know, the delinquencies are up over 8% in terms of office since 2013. So we know there's trouble there. What other sectors do you see as attractive, and where are you guys leaning in?
Yeah, I think I'll talk a little bit more after about this is really about CRE, so I'll talk a little more after about some of our other verticals, our other businesses like our service or our residential business, our energy infra business, etc. But within CRE, what it really comes down to is thinking about who has and who can increase cash flow in case rates do go back up. They certainly have gone back up. And when I think about what has increased cash flow, and I touched on this, multis have, for the most part. Expenses are up, but rents are up massively, so it's offset a lot of the difficulties. Industrial assets have, hotels have, office hasn't, and that's the problem, and that's why we're talking so much about office. But you know, multis are the biggest asset on all of our books, and to me, it's the most interesting with the Fed. You know, if we wrote loans, and the bulk of our loan book, and the bulk of all of our loan books, because we are all 3-year with 2 1-year extension floating rate lenders, the bulk of our books got written in late 20, all of 21, and early 22. And at that point, we all sort of hated retail because retail was still a 4-letter word.
Right.
Office was coming out of COVID. We didn't know how it would play out. We knew that we had to get through to 2025 to see how many people actually renew on an expiring lease to see what it would be. So we really haven't written any office since then. But the place we all leaned in was multis, and the multi business was a pretty good business. We wrote 5 to 6% exit debt yield loans off of 4% cap rate assets. Totally different world for those who weren't around a couple of years ago. You know, there were 3.5 and 4 cap multifamilies, and that's where stuff traded. So So if we thought an asset was a 4 cap and we wrote a loan against a 6% debt yield, we were assuming that was a 67% LTV loan. And if we wrote a 5% debt yield, we were assuming that was an 80% debt yield. Well, so we were expecting somewhere between a 5 and a 6. The good news is rents went up. And for most sponsors, their debt yields are actually higher than that today, which is very good. The bad news is, if I look back to those two scary periods I just told you about, April of this year, October of last year, against a 460 SOFR, and that guy has to borrow it to 250 over that. Yeah, I don't know how you're talking. You need a 7 to 8 debt yield to have the ability to repay any loan that the industry wrote in 2021.
Yeah,
Now against the 3% SOFR, I only need a low 5s SOFR. Against where we're going 3%, I need a low 5s debt yield to be able to get out. So multis are probably the most interesting and the most dynamic, and they're the most levered to this forward curve. Because if we do go to the 3% that we're all expecting it to go to over the next year and change, even the assets. Now I told you I wrote these to 5 or 6 exit debt yield. I told you that income's up more than expenses. They're probably a 6 to 7 debt yield. But I was worried about the 6 debt yield asset, and today I'm not. And it really comes down to who the sponsor is to tell you how much I'm not. If the sponsor is if it's a wealthy family, if it's a large company like Starwood, I feel like if there's a 5.5 debt yield asset that with forward SOFR going inside of 3, that looks like it might make money a couple of years down the line.
Down the road.
We at Starwood would protect that loan. We would buy caps, we would extend the loan, we would do everything we can to stay in.
Sure.
Because we think it's going to be we
Right.
want to own a 5.5 cap rate effectively in the forward market. The problem, what you're seeing mostly on the multi side for what's coming through servicing and what's certainly coming through the bank's books on transitional floating, has been these syndicated loan structures. So in 19, 20, 21, whether it was online or people raising $10 million, 100 grand a piece from 100 different people for a syndicated loan, they never really thought about, away from the reserves. They capitalized reserves, they capitalized interest, but they didn't have any room to go raise more capital, or they have to pick up the phone 100 times, get 100 yeses. If not, dilute a bunch of people, takes a long time. Yep. And the guys who did it did so much of it that it was really too painful to do. So they stopped putting in money. And so they're where the problem is. They stopped renovating units. They quit on their business plan. They didn't have money to put in caps. And we as lenders generically stepped in. People who have great liquidity like we do always stepped in, but some of our peers are probably kicking the can a bit on those. So I think that those loans are going to be in trouble still because they don't have any capital to put in. But with this forward curve, unless you completely blew it on your 4 cap purchase that you thought would be a 5.5 debt yield, and it's not achieving even that today, and you're a low 5s debt yield, you might think about giving back the keys. But in general, this move has made us all feel like, and we have said, we're happy to own your asset at those debt yields. And we have a large property book. We have $3 billion on our balance sheet of Star Property Trust, multiples of that at Star Capital Group, of owned multifamily. And I will sign up today for 5.5 to 6 cap rate assets by taking them in at that debt yield if somebody doesn't perform. So I think the problem will be the syndicators, and that has to play out. And that was a mistake we kind of all made, and we made it. But the better sponsor guys are probably in really good shape. I sort of touched on hotels and industrial. I think both are pretty good. We said in the summer of 2020, when they were all closed, we didn't expect to lose money on any hotel loans. We've always been a decent sized hotel lender, I would say today, and I said it on our public earnings call, I still don't expect to lose any money on anything in our hotel book. Anyone who's gone away to any cities lately has seen occupancies are up, and certainly ADRs, average daily rates, are up a lot. So RevPARs are up, and absent union boxes where your expenses are up a lot. I think that you probably made a big mistake if you wrote a hotel loan that is significantly off its business plan today. Retail is no longer a 4-letter word, certainly not in the CMBS market. CMBS market likes retail. I've sort of liked retail in 2017 and 18 when these white papers were being written about short CMBX 12 and these things are going to be negative. People lost a lot of money. Some big name people, I won't say their names here, lost a lot of money on that. And we went around to a bunch of hedge funds because we have this massive servicer. We have $100 billion of name servicing. We've worked out $100 billion of assets. We have data on every asset and every block, who the borrower is. And we went back through, and then we looked at the negative cash flow of shorting those assets for the 6 years or so that it's going to play out. we were pretty optimistic on office. We did lighten up then a little bit, but excuse me, on retail. But I don't think retail is a 4-letter word. We can only use so many pickleball courts and adaptive reuse.
Right.
At some point, it's going
Those might be getting overbuilt, right?
But I think most people, not me, still buy the groceries at a grocery store, and that lasts for a little while. And power centers are sort of seemingly fine. So it really, with this SOFR curve, we have an office problem. That's it.
Yeah, we definitely do. And we'll just, I mean, nobody knows how that's going to play out, right? I mean, it's probably a multi-year problem, I would guess. And when you don't have, like you said, folks within our own governmental agencies going back to work in DC, and, even quite frankly, some of the banks that we work with, Jeff, people are not in all banks, but in some of the banks we work with, only working in the office 2 to 3 days a week. And that just has really changed that whole model.
I want to put a shameful plug in for my Starwood Solutions business, and we are working with borrowers and lenders to help them figure out what is the path forward. We've been 100 billion of these workouts, and this is a business for not much money. I think we can help people sleep more at night, and we'll talk about it as we talk about the service some more. But when I look at office, you said I don't know where it goes, and I would say I don't know either. And I am probably more pessimistic than most. And my theory is fairly simple. I have some empty office buildings where the GSA tenant in DC is never coming back, and that's going to be difficult. Or I wanted to do a multi-conversion. I couldn't get rid of tenants in Houston, and I'm going to have to sell that at a lower price that's reflected in my financials today. But something, right. I have an empty old department store in downtown LA that was going to be an office conversion. Google, Amazon, whatever, aren't taking 1 million square feet in downtown LA anymore. Right. So I know I have some issues, but for the most part, my office book is going to look like something like 70% occupied building. Net effective rents are down because we are giving out more in TIs and LCs to get people there. You have to upgrade mechanicals, lobbies, elevators, whatever, and the net effective rents aren't that good. And if you use a net effective rent and you cap it at today's cap rates, where offices aren't really trading, but where we perceive cap rates to be, you really don't even want to write that loan. But I might have a 6 or 7 debt yield office building that covers its operating expenses, covers a large portion of its debt. The owner is going to make the same generational decision: do I want to continue to support this or not? And let's just say that's a 85% lease market. It's a 15, but that's probably too high today. 82% lease market. It's an 18% vacant market, and you're at 70%. It's pretty easy for me to say I'm at a 6 or 7 debt yield today. If I just get up to the average occupancy of that market at 82,
right,
my debt yield is going to go to 8 or 9, and I potentially have escape velocity on that loan at an 8 or 9 debt yield, and that's interesting. I'm not so afraid of that. But where I lose sleep, why I think that more of the iceberg is still underwater than above it, is because I think about a city block in a major MSA, and there's 4 corners on the city block. All 4 owners, let's assume, have the same basis from sort of pre this rate rise, and one of them is given up, and the bank is taken over, and either the bank owns it at a better basis, or whoever bought it from the bank owns it at an even lower basis than that.
Sure.
Now we're all 70% occupied. I'm telling you, if I could just get to 82, I think I have escape velocity. I think it's going to be very hard for the other 3 buildings to get to 82, because the guy with the better basis is going to win every lease until he gets to 100, because he can simply write leases at lower net effective rents that he doesn't have to justify yesterday's basis with. So that's why I say I think that more of the iceberg is below the water, because I think that's a 5 to 7 year play out problem. You're not going to know the answer to this question in 2025 or 2026, but absent a significant move lower, or absent people really coming back to work, I think there is a domino effect that will continue to happen by virtue of someone with a lower basis in your market getting all your tenants. And
I think you're right. It makes total sense.
And so I'm much more sanguine on the potential for that to recover quickly. I just don't think it does, and I think that tenants are smart and they will wait for a better opportunity, and there's going to be a better opportunity with someone at a lower basis. So it's going to be a while. It's my opinion. Okay,
let's talk about the special servicing side of your business. You guys bought a number of years ago, I think over 10 years ago now, L&R.
Yeah.
And L&R was the largest special servicer in the U.S. And they're somewhat, I mean, I kind of view them a little bit as a hedge for you guys in terms of your other lines of business. So tell me how that's going. I mean, obviously, their business has expanded a great deal. So tell me a bit about that and Starwood Solutions, because I think it's really interesting what you guys are bringing to the market.
Yeah, thank you. You said it right. I wasn't here. I was on the external board, but I had nothing to do with us buying L&R, but it was a brilliant purchase by Barry and the team at the time. It gave you a business. At the time, it was still working out a lot of legacy GFC assets. So it had higher income than it has had really since. That income has gone down. Now it's going back up, and it's going to go significantly from here. But it was a positive carry credit hedge. It costs us something to run it, but it doesn't cost us as much as we make. We were named special servicer as little as 5 years ago on like 60 billion of CMBS. Today we're on 100 billion of CMBS. So we've been able to grow it while moving our investment in B pieces below investment grade CMBS. So think double B, single B. We've reduced that by 50%. So we have less investments, but we have more special servicing. Why is that important? The way that the special servicing business really runs is the majority holder of the lowest rated outstanding bond tranche gets to name who the special servicer is. So obviously, if you have a lot of capital and you own a lot of B pieces, you name yourself. And
right.
Historically, that was the big part. But through being the highest rated special servicer in the market and having the best people and doing this for the longest amount of time, we've been able to forge partnerships with a lot of other owners of mezzanine CMBS and B pieces where they've made us their special servicer because they think they're getting better outcomes with us. So we've been able to massively increase the amount in special servicing. Revenues haven't gone up as much as you would expect, given you talked about 8% in delinquency in CMBS. But a lot of this is this business wants to see credit distress and revenue that offsets my losses and credit from other places. You called it a hedge, and I agree 100% that it's a positive carry credit hedge. And I'll make more money, obviously, as things get difficult in the servicer. But I just lost my train of thought. But sorry. Going into the servicing, I remember. I'm sorry, so sorry. So the GFC happened, right? And in 2008, 9, 10, 11, there was no CMBS issue. And so in 2012, the CMBS market came back. In 2013, it came back in size, and it stayed large until 2019 or so. So what people don't realize is the servicer isn't going to make a lot of money until we start getting those bigger vintages to mature. So the 2013s matured in 2023. It takes a year and a half or so to work through. So that's 24 and 25 income. And then we get into these really juicier years in 2014, 15, 16 and CMBS. And that's revenue that we expect to make in 2024, 25, 26, 27. So the problem, why we haven't seen as much revenue is because it just doesn't line up with when CMBS markets were big. But we expect it to make a lot more money going forward than it's made going back, and we've already earned way more than we would have. And the other thing that it gives us, than we paid, excuse me, the other thing that it gives us is most of our back office are phenomenal. CFO Rena Pannery and her whole team sort of came over from L&R, and it gives us an office in Miami that Barry and I get to spend the winter in. So I'm very fortunate to have that and a reason to be in Miami. But it gives us a couple of hundred people on the servicer and all of their information and data, and that just makes us the stuff that is on the good side of the Chinese wall. We definitely have a wall. Anybody who works with us in solutions, we will have a wall. We will not see your data, and that's the same for private public on the CMBS side. But we're smarter. We have more people. We have more data than we've ever had before, and it allowed us to create this Starwood Solutions business. We looked when the regional banking crisis sort of started with Silicon Valley Bank. I stayed in over a weekend and did some work for Barry. He asked me, "Where's First Republic going to open up on Monday?" And he stood over my desk, and I remember and I said, "Well,
no pressure.
Book value is like 79. It's trading at 77." I said, "Ooh, difficult question." I started going in, and it's like $160 billion of assets, mostly fixed rate. 102 billion of them were residential mortgages with an average coupon of 2.97%. So way below market given this rate rise. The only hedges that I could find were like a $6 billion pay fixed Freddie swap. So it was generically a fixed rate book that was offsides from a credit perspective. And if I had to liquidate all the assets, all of the securitized assets and all the loans at a liquidation price, I came up that weekend with a negative $102 a share book value to liquidation. So because that was such a weird number, me and one of my senior traders, guy Nathan Bressler, who's also amazing, stayed over the course of that weekend, and we looked at 15 other banks, and they were all negative to liquidation. And that's obvious. When you're 10 times levered and your loan book's worth less than 90, you're negative. Never mind taking out goodwill, TP&E, deferred tax assets, all the things that someone like me modeling would take off. So yeah, you had a big problem in that market, and so we looked at that, and coming off that, we said, these guys are going to have large problems. They're going to have to work things out, much like what you do better than anybody in terms of trading these loans and being able to provide liquidity to people who need it. We thought they would need solutions, and we thought that they
actually have traded some of those loans, by the way, but go ahead. Yeah.
We thought they would love to lever the resources that we have, hundreds of people and hundreds of billions of dollars of workouts. You can go get a appraisal or a BPO on an asset. It's not worth the paper that it's written on generally, and it may force a accounting repercussion by getting an appraisal that you don't want. So we said we can value any asset very quickly. We can have value any portfolio of assets very quickly anywhere in the world or the country. We have more data than anybody to do it. We're going to get a better answer than them. But more important, we've been through so many of these workouts, whether you're a borrower or a lender, we're going to be able to tell you, here's what's going to happen over the next 6 months. Here's the cadence. Here's the day that this is going to happen. And here's how we would react. Here's how you would react, and really come up with a formidable business plan to help you decide, do I stay in or not? Or do I sell today? Do I not? And what's my next year going to look like? And sitting here in COVID, myself losing sleep, sitting here in this rate rise, losing sleep, there are a lot of CIOs and CFOs and CEOs at regional banks that just don't have the resources. They have the resources to write a few loans. They don't have the resources, and they've never been through a workout cycle like this. So nobody's really staffed to go through this. And you can go to a Citus or somebody who doesn't do this exactly for a living, but they kind of own the market on solutions. And we're like, we want to be BlackRock solutions for securitized products. We want to be that for real estate. We want to be the people who can help you evaluate and hold your hand through a difficult process, get paid a small fee for it, but the fee is nothing compared to this and what you could potentially save. So in the last year and a half, we have a team under Adrian Coyle and Adam Bellman who runs the special services for us, that are out talking to all of the regional banks, et cetera. And we're super excited about this business because we want to be part of the solution.
Absolutely. And to your point, and and I know, because of where we grew up, there's a lot of those senior level people that have since gone on to do other things or retired or whatever you want to call that, transitioned into their next phase of life. And so the need for solutions like that, I think, is really, really great. It's very difficult to take a lender and move them into special assets and say, play that role. I mean,
anybody who would like to talk to our team, it's free to have a discussion. Please reach out to Bliss if she wouldn't mind.
Sure, absolutely.
We would love to engage anybody on.
We'll do that. Okay, we've got a couple of questions from the audience. And since we've only got about 7 minutes left, I'd love.
This happens every time I speak, by the way.
That's all right. It's because
we don't get through enough.
It's good. It's good. Okay, so where will Starwood look to invest in the distress space? What are you thinking?
Super interesting question. So there are portfolios. We're looking at all of them. We have the ability to underwrite and rip a portfolio very quickly. We'll certainly look at distressed single assets as well.
And you're raising a pretty big fund. Aren't you at about $4 billion?
Yeah. So the equity side of our business is at a little over $4 billion. I don't know what's public, so I'm not going to quote it, but it's going to be a $10 billion fund, much like our last fund. And then we have a distressed fund away from that on the equity side of our business. The natural place for a distressed loan would be in Starwood Property Trust, where I sit every day. The problem with putting distressed loans in a Starwood Property Trust is they're probably on non-accrual. They're not current. I'm going to buy them at a discount. I can't accrete that and pretend like it's income. But if I don't ultimately get that income, I've effectively drank my own blood. I paid a dividend that I didn't actually earn. And so we're always a little bit afraid of that. I'm also afraid of getting on my earnings call with more 4-rated and 5-rated loans. Even if I bought them at a discount, they're going to be loans that I have to talk about. So they're not perfect for a REIT because they're not current, and they're not perfect for a public company because I have to talk about them. So we're looking at all of them. We were a cover bid on the big signature pool at Starwood Capital Group. We're going to continue to look at and we're looking at a lot in Europe. The performing portions of those Starwood Property Trust be a great home for. We have almost $2 billion of liquidity today. We have plenty of capacity, and we want to write 4 or 5 billion of loans in the next 6 months if we can. So we're a great spot for the performing, but the non-performing will probably be out of the public vehicle and in more of a distressed fund, whether it's a distressed equity or debt fund. But
yeah, that makes sense. So what do you think? Do you think now that the Fed has acted, you know, is it a soft landing? Are we still headed into a recession? I mean, what are your thoughts?
I'm not smart enough. I just saw some data today on you know, Barry's been talking about the fact that these employment numbers are wonky. First of all, the inflation numbers are wonky because of rents and whatever. We won't go there. But the employment numbers are wonky because the first thing that usually rolls over is construction jobs. And at the same time, we have all these Build America Acts, CHIPS Acts, and all these Infrastructure Act, and all this money that's going to public construction. So we never really saw a dip in construction, and that's like the first thing down. The second thing that typically happens here is healthcare and teachers, and you start to see those fall off. Well, we need more teachers, so that's not happening. In healthcare, the baby boomers, unfortunately, you know, you and I are entering. We need more, not less, and we're way understaffed, and we have a massive need, right? And so the three big areas that typically roll over fairly quickly didn't have any rollover and held the employment number sort of really tight. I just saw today a construction job thing that has us really rolling over as the public money. You know, you stay here at high rates for long enough, and none of us are doing we're not doing a 5 or 6 yield on cost build deal in commercial real estate, and there's going to be a lot of idle construction workers if rates don't go lower. But we are seeing it today. So stubbornly, I don't think we go to a recession if we need more teachers, we need more healthcare people, and construction starts to pick back up. But I think we're going to slow down enough that we don't need 300 basis points of real rates. And 5.25 is just way offsides versus the 3 heading to 2 where we are. And I think we'll go back to a more neutral 3. And I think the forward curve's got it pretty right. It's got for Fed funds going to 3 and then kind of staying there. Probably we don't know past that, but we're certainly too high today. But there's too many offsetting factors to think we're going into a heavy recession that getting back down to a 2 or below is in the cards today.
Yeah,
curve will normalize and I don't want to talk recession on the day when I'm drinking champagne.
When you're
a purple champagne out of a Gatorade bottle. Yeah.
Purple champagne, huh? Wow. That's great. Purple Gatorade champagne. No, all very, very good points. And I think it's going to be interesting to see how the banks navigate, rates coming down, yet, what they're facing. And we see this in a lot of the loans that come through our shop.
Yep.
Some of them still have loans that are fixed, in the 3s, never moved. I mean, they wrote them out. Some of them 7 years, 10 years. We've seen them longer than that.
Yeah, they didn't lose the maturity lottery.
Yep, there you go. And in addition to which, they were writing CDs to bring deposits in or keep deposits within their institutions up above 5, and they're tied into those. So that is an interesting question, right?
Mm-hmm.
How that plays out.
Yeah, everyone that's offsides is a little bit less offsides today, but we all watch football. Offsides is offsides. You're still offsides, and you still have to deal with it. On the back of that story I told you about the regional banks and staying in all weekend and trying to figure out what some of those valuations were. The first people, and I actually golfed with them this weekend again, but the first person that I saw on the Sunday afternoon, I went to my country club to hit some golf balls, and it was Lloyd Blankfein. And I told Lloyd, ex-Goldman CEO, for those who weren't around,
right.
I told Lloyd what I had found out, and he said, Jeff, pretty simple. Banks need to move back to mark to market. And I responded, how the hell are they going to move back to mark when they're 10 or 15 points offside? He said, that's why rates are going lower. And now this is a year and a half ago, and they're only now starting to go lower. But offsides is offsides. And until rates go back to where they were and nobody's dealt with these problems, there's still going to be stress on these banks. What I took away from that, over that week, how did I get comfortable, not to short the entire sector, and ultimately didn't. And I said to Barry on the Sunday night before they opened on Monday, I said, the Fed will come out with the liquidity program, because this is about liquidity. It's not about liquidation. And as long as there's a congressman in every district that has a regional bank in their district, and they want that regional bank to continue to give $100 a year to their congressional fund, they are not going to all of Congress is not going to let regional banks die, and they're going to
Right.
provide the liquidity that they need to provide the safe landing. And so offsides is still offsides, and it's getting better. And we're not going to go to full mark to market. I don't see that happening. But if you go back to where we were in rates, and you go back to a 25 base point Fed funds, wouldn't be the dumbest thing to have a discussion about going to mark to market at that point, because nobody's offsides anymore, and you haven't ruined the banking industry.
There you go. And someday we'll be looking in the rearview mirror and we'll know how it turned out. Jeff, thank you. Have a great afternoon. I thoroughly enjoyed it and I learned a lot, which is always awesome.
Thank you. So nice to be with you.
Take care. Bye now.